So we have learned about the income statement. Now what we are going to do is we're going to talk about the matching principle. Now the key thing on the income statement is to match revenue with costs. And the goal of the income statement is simply to take the revenue or sales that we talk about and subtract all the costs and figure out if there's anything left over. Now we want to match revenue and cost together. So to do the matching principle, what we're going to do is to illustrate this using a very simple example. So what we have here or in this illustration is a simple business that we are starting. It's a delivery service, and on day one, I spent 60,000 to purchase a truck. Okay, let's say I spent 60,000 cash on the truck. And if you look at the illustration here, in the first 2 months, we're going to do $10,000 worth of revenue. And our cost of goods sold is going to be about $5,000. So my gross profit is $5,000. And then I need to allocate about $3,000 worth of operating expenses. And then of course, I paid cash for the truck in month 1. And so I charged that to month 1. So if you do your math here, in month 1, we lost about $58,000. And in month 2, we made $2,000. Now, the question I ask is this. Is that good accounting? Have I properly matched expenses with revenue? If you think about it, and if you look at this illustration here, the answer is clearly no. And that's a very interesting thought, because what you're saying is, I'm using the truck to get revenue in month 2, but I have no expense related to the truck in month 2. So what should I be doing with the truck in order to show good, accurate profit and loss accounting? And in order to do that, I need to match the cost of the truck with the revenue that it generates. And since I charge it all off in month 1, I haven't properly accounted for the truck. Now, accountants use a term called capitalization. In other words, we are going to spread the cost of the truck over its useful life. We use a technique called depreciation. And in other words, we're going to depreciate that truck. Now, there's a problem with depreciation. When we hear about depreciation as individual, we all think about the truck loses value over time as we drive it. It wears out. It's not worth as much as time goes on. And that's called economic depreciation. For an accountant, in depreciation, it is about cost allocation. All I want to do is spread the cost of that truck out over 10 years that I'm going to be driving, say. So let's assume we think that the truck will last 10 years. In any case, in Singapore, the COE only lasts 10 years. So good accounting would say we need to depreciate. So what I'm going to do here is I'm going to depreciate that truck, assuming that it will last for 10 years. Now remember, we go to the standard and we look at the rules on how to depreciate a truck. And we're going to have a range anywhere from 5 to 10 years. Those kind of things. So what we have is that over 10 years is 120 months that we have on the truck. And that is our guesses. And the truck costs $60,000. Now, let me just point out something here, that to take $60,000 on the truck and depreciate it over 120 months, we're going to have to go to a higher level of counting here. In other words, we're going to have to divide. But definitely, I'm sure you all can handle that. So if you divide 60,000 over 120 months, you get $500 a month. So we depreciate $500 a month. And if we put the depreciation in here, we'll see that the income statement changes. Now we have $10,000 of revenue on this illustration, $5,000 of cost of goods sold, and we have $5,000 of gross profit, $3,000 of operating expenses, and then $500 each in those months for depreciation. And what we have here is we make $1,500 rather than losing a lot in month 1. We are now making $1,500 just because we match the cost with the revenue for each individual month.